Today, we're talking about the middle class, the backbone of our economy. But let's be honest, being middle class can feel a bit like navigating a financial maze. Debt, lifestyle creep, and unexpected expenses can leave you feeling trapped. So, buckle up because we're about to expose the money traps the middle class falls for and equip you with strategies to escape them. The allure and the danger. Common money traps are trap number 1. The keeping up with the Joneses trap, the filtered fantasy versus. Your financial reality. Social media and advertising bombard us with images of seemingly perfect lives, luxurious vacations, designer clothes, and extravagant experiences. This constant barrage can trigger feelings of inadequacy and pressure to keep up with the Joneses, even if it means stretching your budget thin. Here's how the keeping up with the Joneses trap works. Curated perfection. Social media feeds are carefully crafted to showcase the best moments and most luxurious experiences. This creates an unrealistic portrayal of life, making your own reality seem inadequate. The fear of missing out. FOMO marketers exploit FOMO, the fear of missing out, to pressure you into spending. They create a sense of urgency and exclusivity around products or experiences, making you feel like you need them to keep up with the trends. Targeted advertising. Social media platforms track your online activity and interests, bombarding you with targeted ads for products you might not necessarily need. This constant exposure can lead to impulse purchases that erode your budget. Breaking free from the Joneses trap. Be mindful of who you follow. Curate your social media feed with accounts that inspire, educate, and uplift you. Unfollow accounts that trigger feelings of inadequacy or pressure to spend. Focus on real connections. Prioritize authentic interactions with loved ones over the filtered portrayals on social media. Invest in real-life experiences that bring you joy, not just experiences you document online. Practice gratitude. Take time to appreciate the good things in your life, big and small. Gratitude helps combat feelings of envy and fosters a more mindful approach to spending. Trap number 2. The house you can't quite afford, the dream versus. The reality. The dream of homeownership is powerful, but buying a house that stretches your budget thin can be a recipe for financial stress. Let's explore why this trap is so enticing and how to navigate it responsibly. Emotional attachment. Homeownership is often seen as a symbol of success and stability. This emotional attachment can cloud your judgment and lead you to overspend on a house that might not be financially sustainable. Hidden costs. The sticker price of a house is just the beginning. Factor in property taxes, homeowners insurance, maintenance costs, and potential repairs before committing to a mortgage that strains your finances. Lifestyle creep. A bigger house often leads to lifestyle creep, the tendency to spend more on furniture, renovations, and upkeep. Be realistic about the ongoing costs associated with homeownership. Avoiding the overextended homeowner trap. Prioritize affordability. Don't get swept up in the emotional allure. Focus on houses that fit comfortably within your budget, leaving room for other essential expenses and financial goals. Consider all costs. Factor in property taxes, homeowners insurance, maintenance, and potential repairs when calculating your true monthly housing cost. Don't just focus on the mortgage payment. Plan for the future. Think about your future needs and plans. Will this house accommodate your family's needs for the foreseeable future? Is it located in a good school district if you plan to have children? Trap number 3. The car conundrum. New versus used, lease versus buy. Cars are often a necessity, but they can also be a significant expense. The middle class can easily get caught in the car conundrum, unsure of the most financially sound option. Let's explore the pros and cons of different choices. New cars. The allure and the downside of pros. New cars come with the latest technology, safety features, and manufacturer warranties. They offer a sense of pride and potentially lower maintenance costs in the initial years. Cons. New cars depreciate rapidly, losing a significant portion of their value the moment you drive them off the lot. Car loans for new vehicles often have higher interest rates, leading to higher monthly payments. Additionally, full coverage car insurance is typically required for finance cars, adding to the ongoing cost. Used cars. Finding value and avoiding pitfalls are pros. Used cars offer a more affordable entry point and experience slower depreciation. You can find reliable, well-maintained used cars that meet your needs without the hefty price tag of a new car. Insurance costs are typically lower for used vehicles. Cons. Used cars may require more frequent repairs and maintenance as they age. Research the specific model and year you're considering to avoid known reliability issues. A pre-purchase inspection by a trusted mechanic is highly recommended for used cars. Leasing versus buying. Understanding the trade-offs of leasing. Leasing is essentially renting a car for a set period. Monthly payments are typically lower than financing a new car purchase. At the end of the lease term, you return the car and have the option to lease a new one. Cons of leasing. You don't own the car at the end of the lease, and there are mileage restrictions that can incur additional fees. Leasing typically doesn't allow for customization and may come with limitations on wear and tear. Choosing the right path. The best option for you depends on your individual needs, budget, and driving habits. Here are some key factors to consider. How long do you plan to keep the car? If you want to own the car long-term, buying a used car with good resale value might be a better option. How much are you willing to spend on repairs and maintenance? Expect to budget more for repairs with older used cars. Do you need the latest technology and features? If cutting-edge features are a priority, a new car or lease might be more appealing. Trap number 4, the debt deluge. Navigating credit cards, loans, and high-interest rates debt can be a powerful tool when used strategically, but it can also become a suffocating burden for the middle class. Let's explore the different types of debt and strategies to avoid drowning in it. A credit card debt. The crippling carousel credit cards offer convenience and rewards, but they come with high interest rates. Minimum payments often only cover interest, not the principal amount, trapping you in a cycle of debt. Avoid using credit cards for impulse purchases and only charge what you can afford to pay off in full each month. A student loan debt. The burden of knowledge. Student loans can be a significant financial burden for many middle-class families. Explore scholarship and grant opportunities, consider community college options for initial coursework, and choose a degree that aligns with your desired career path and earning potential. There are also various repayment plans available for federal student loans, so research and choose the one that best suits your financial situation. Predatory loans and payday advances. A slippery slope. Predatory loans often come with exorbitant interest rates and fees, targeting financially vulnerable individuals. Avoid these loans at all costs. Consider alternatives like a personal loan from a reputable lender or a credit union, but only if absolutely necessary. Strategies to break free from debt. Create a debt repayment plan. Prioritize paying off high-interest debt first, such as credit cards. Consider the snowball or avalanche method, allocating extra funds towards the debt with the highest interest rate first. Explore debt consolidation. Debt consolidation combines multiple debts into one. Trap number 5, the educational debt dilemma. Navigate the maze to financial freedom. Student loan debt can be a significant burden for middle-class families. The high cost of education can leave graduates shackled with debt for years, impacting their ability to save for a home, start a family, or invest for retirement. Let's explore strategies to navigate this educational debt maze. Exhaust all scholarship and grant opportunities. Before taking on any loans, research and apply for scholarships and grants. There are many funding opportunities available from federal and state governments, universities, private organizations, and even local businesses. Utilize scholarship search engines and explore resources offered by your desired schools. Consider community college options. Community colleges offer a cost-effective way to complete foundational coursework before transferring to a 4-year institution. This can significantly reduce your overall student loan debt. Choose a degree program with earning potential in mind. While pursuing your passion is important, consider the job market and the earning potential of your chosen degree. Research salary data and career outlook information to ensure your investment in education translates into future financial security. Explore loan repayment strategies. There are different federal loan repayment options available, such as income-based repayment plans and public service loan forgiveness (PSLF) programs. Research these options and choose a repayment plan that aligns with your income and career path. Prioritize high-interest debt. If you have both federal and private student loans, prioritize paying off private loans first due to their typically higher interest rates. Consider debt consolidation strategies to streamline your repayment process and potentially secure a lower interest rate. Trap number 6. Neglecting retirement savings. Planting seeds for a secure future retirement might seem far off in your 20s and 30s, but the power of compound interest is real. Starting to save for retirement early, even with small amounts, can significantly impact your future financial well-being. Here's how to break free from the trap of neglecting retirement savings. Take advantage of employer-sponsored plans. Many employers offer retirement plans like 401(k)s or 403(b)s with employer matching contributions. This is essentially free money. Contribute at least the minimum amount required to receive the full employer match. As your income grows, aim to increase your contribution percentage over time. Explore additional investment options. If your employer doesn't offer a retirement plan, or you want to save more aggressively, consider opening an individual retirement account (IRA). Traditional IRAs offer tax-deferred growth, while Roth IRAs offer tax-free withdrawals in retirement. Automate your savings. Set up automatic transfers from your checking account to your retirement savings account. This pay-yourself-first approach ensures you're saving consistently without having to think about it. Even small amounts compounded over time can make a big difference. Seek guidance. Optional. Consider consulting a financial advisor to discuss your retirement savings goals and develop a personalized investment strategy. A financial advisor can help you choose the right investment vehicles based on your risk tolerance and time horizon. Breaking free from the maze. Strategies for financial freedom. The good news is, there's an escape route from the middle-class money maze. Here are some actionable strategies to take control of your finances and build wealth. Craft a budget and track your spending. Knowing where your money goes is crucial. Create a realistic budget, track your expenses, and identify areas where you can cut back. Numerous budgeting apps and websites can help you with this process. Live below your means. Don't spend more than you earn. Resist lifestyle inflation and prioritize your financial goals over fleeting desires. Embrace delayed gratification. Learning to wait for what you want can be a powerful financial tool. Instead of impulse purchases, prioritize saving for larger goals. Explore side hustles. Consider generating additional income streams through freelance work, online businesses, or a part-time job. This extra income can help you pay off debt, save for the future, or simply create a financial buffer. Educate yourself. Financial literacy is key. Read personal finance books, listen to podcasts, and take online courses to improve your financial knowledge and make informed decisions. Seek professional help. Optional financial advisors can offer personalized guidance and create a financial plan tailored to your specific needs and goals. Consider consulting a professional, especially if you have complex financial situations. By recognizing the influence of social media and prioritizing financial literacy, you can take control of your financial narrative. Remember, financial wellness is a journey, not a destination. With knowledge and a proactive approach, you can break free from the cycle of feeling broke and build a secure financial future.